We had a fairly mixed day right across the market, and in fact everyone was waiting for the earnings of Nvidia, who have now reported after the market close. Now we can see they are down currently after hours. In fact, they've been down as much as 6%. So we're going to take a look at the earnings and understand what has gone on with this company and a bit of a deep dive and run it through the valuation process. Now, as we can see, this was the third quarter for the fiscal 2025 report, and in fact, it was a double beat, a bit of a spoiler. They recorded record revenue, 35.1 billion. That is up 17% from the previous quarter and up 94% from the same quarter last year. Now, in particular, the one that is of importance to investors is the data center revenue. That is up 30.8 billion, 17% up from the previous quarter, up triple digits, 112% from the same quarter last year. Now that is very good news for shareholders, a double beat, that is what we typically want to see. And on the earnings per share, 0.78, up 16% from the previous quarter, and we can see again triple digits from the same quarter last year. Now, a few words from Jensen Huang. He is saying the age of AI is in full steam, propelling a global shift to Nvidia computing, something that I'm sure is music to shareholders' ears. He also talks about the demand and anticipation for Blackwell, which is in full production, and also AI is transforming every industry, company and country, and also talking a key point here in relation to industrial robotic investments. They are surging with breakthroughs in physical AI, and that countries have now awakened to the importance of developing their national AI infrastructure, and he believes that they are all coming to Nvidia and they will continue to grow at the astronomical rate that we have seen in the past. And when we take a look at it in this tabular format, what is very key is data center. 30.8 billion is what they reported this quarter. Just look at Q3 in 2024, 14.5 billion. That is more than double from the same quarter last year. And it isn't just the data center. We are also seeing growth in every single other stream. We have gaming, professional visualization, auto, OEM and other. But as we can see, the main driver for this bottom line increase at 35 billion for the quarter has come from that jump that we do notice from data centers. So great news, definitely something that now shareholders can relax. However, as we mentioned, the share price is down. It will be interesting to see where this goes over the next few days. Now, over the last 12 months, this company is still up astronomically, up 189%. And if you've been a long-term shareholder, you would be up more than 27,000%, probably the best performing company in your portfolio. Now, it does trade right now towards its 52-week highs, even after the 2 to 3% drop we are currently seeing. Bear in mind, it is fluctuating a lot. In terms of Wall Street, we get that strong buy. However, both Seeking Alpha and Quant give it a hold. But do notice, Quant at 3.49 isn't far off the 3.5 that in turn would make this a buy. We also notice the forward P, we'll cover that shortly, looking very high at 51.4, and the forward yield, again, it does pay a dividend, very small, we have to mention it here, at 0.03%. Now we can see this is breaking news right across every single broadcasting. Nvidia earnings forecast top expectations as age of AI is in full steam. Again, really showing that they don't believe this is one thing that is going to slow down. They believe the growth is going to continue. As we've already mentioned, their earnings per share of 81 cents, that was above analysts. They were expecting 74, and their revenue 35.1 billion. In fact, that's pretty much nearly 10% higher than what they were expecting for the quarter of 33.2 billion. They've also set some nice expectations, 37.5 billion for Q4, and we do notice Wall Street themselves were expecting lower at around 37 billion. So great news, not just a beat on the EPS, not just a beat on the revenue, but they also guided for the next full quarter to be marginally higher, nonetheless still higher than what Wall Street were expecting. At this point, you pretty much feel like you can bet your whole house that this company is going to continue to be with such a great track record they have, definitely in the shorter term. Now, the rest of the information we have already covered, especially from Nvidia CEO Jensen Huang, very bullish on the growth of this company and in fact just AI as a whole. When we've taken a look at essentially the growth of the industry, Bloomberg themselves, and this was around a year ago, June 2023, maybe a little bit more than a year, they believe that this industry as a whole could grow at 42% year on year, and we are starting to see some of that come through the numbers that Nvidia are reporting, just growing at such a mammoth rate. Now, the final piece of commentary from this latest earnings, what I really wanted to draw your attention to, it was great to see their top line, 35 billion, an increase to the previous quarter, and that is up 17% as noted on a quarter-by-quarter basis, up 94% from the same quarter last year. But one thing we didn't take a look at was their margins. Now, it has come slightly under the previous quarter at 74.6, and 75.1 was reported in Q2. But nonetheless, this is still a company that is growing their top line at a very rapid rate. Margins are only a little bit lower, but we do notice when we step back and look at the same quarter last year, it is a little bit higher. So no real worries that we can see right off the bat in terms of the margin, and we can also see their bottom line is increasing, up 16% on a quarter-on-quarter basis, up 109% when we do look at that same quarter from the previous year. Now, there are other informations here, but we have pretty much captured this through this slide, which I do believe is very good to look at if you want to see the growth on a quarter-by-quarter basis. But one thing we can take a look at of this company, we've already mentioned it today, but they are a company that continue to grow. In fact, over the next 3 quarters, they've just announced Q3, still believe they will get double-digit increases to the EPS on a year-on-year basis, and it would not be wise to bet against them hitting that, given now with Q3 reporting, out of the last 5 quarters, they have outperformed 100%. That is 5 out of 5. Now, if they do hit the EPS estimate for the full year of the next accounts, January 2026, the forward P will come down to around 34.89. Whether or not you believe that is reasonable, S&P right now, for context, is 25, is just something to consider. Now, this is a company that has some phenomenal metrics. You need to understand this whether you're an investor or considering investing. We'll touch upon dividend safety. The information is here, but as we said, this yield is very trivial. It is 89 and very safe, and we'll take a look at this model and what they believe is essentially the valuation. One thing though that we can point out, whilst it won't have a large effect on you unless you have a significant number of shares, they did increase that dividend at 150% in May this year. Now, it was reaffirmed in September. Dividend is very safe. Again, not going to take anyone by surprise, but this ultimately means a dividend cut for Nvidia is highly unlikely. Now, typically for companies we review on this channel, we look at some key metrics from the recession 07-09. No dividend was paid, so no comparative data. They had negative 35% recession sales. That was well below the average of the S&P at negative 12. And we do also note negative 78% was their recession return, massively trailing the S&P's negative 55. Now, yes, nice to see the dividend increase 150% in May this year. But look, over the last 5 years, it's been 1%. Over the last 10 years, 7% is good, but it could be a lot higher. This just goes to show us, as we'll show you from the payout ratio, that management aren't particularly focused in increasing the dividends. It isn't priority from their capital allocation. Nonetheless, they have been paying a dividend for the last 11 years without a reduction. Now, this valuation model is based on the P/E ratio over the last 12 months. Now, the blue tunnel indicates the fair value. We can see right now it is trading at reasonable valuation. It's sitting around the middle, but remember, as always, we're not looking at any valuation model in isolation. We're going to run it through our own, and more specifically the DCF model shortly as well. Now, typically, dividend yield theory tells us when a company is undervalued when the yield sits above the 5-year average. Right now, it is lower, but we're not going to use this model today as the yield isn't a focus of this company. Forward P, however, this does give us a signal of marginal undervaluation. 40.4 is lower than the 5-year average of 42.9. But bear in mind, this company sits well above the information technology at 25.1, Nvidia's 40.4, meaning it is trading at a massive premium. Now, you might argue, and probably rightly so, it does deserve the premium. Question is, how much of a premium? And that is something we will cover. Now, throughout this channel, and when we do other companies, we draw your attention to the free cash flow. Earnings is susceptible to manipulation by management through accounting, and we want to see below 50% for semiconductors. this ultimately gives us faith management can increase those dividends at a double-digit rate. Now, this is well below 50%, in fact decreasing, and at 1% in 2024, 1% over the next 12 months. As we said, it isn't a priority of management. If they wanted to, they could do another 150% increase in 2024. Now, free cash flow, we want to see consistent increases over the longer term. We get some very sharp growth in the last few years, but over the longer term, it hasn't been as strong as we want to see. Nice to note though, from 23 to 24 and expected over the next 12 months, nearly triple. This company's growth journey looks like it is just beginning. In terms of sales growth as well, typical companies 3 to 7%, 3 to 4 just keep up in line with inflation. Nvidia for the large part, double-digit growth. 2024 trailing 12 month showing signs of triple-digit growth. This is something we do love, but remember it also does trade at a rich premium, something that maybe you could argue is justified based on the growth rate. And here we can see total sales on a numerical format, 27 billion in 2023, more than double in 2024, and expected to nearly double again purely by looking at that trailing 12 month at 96 billion. Now, we love it when companies do share buybacks, returning excess cash to investor pockets. What we've noticed here over the last 10 years, net position, they would have diluted your position as a shareholder as they did issue a lot of equity. One thing to note though, in the more recent period, they have been looking at doing share buybacks. And as we've mentioned in previous quarters, they did announce a very large share buyback program. So we do anticipate they will be essentially returning excess cash to investors through this in the shorter to medium term. In terms of ROIC, one of our favorite metrics, 10% or more, 12% for semiconductor industry, give us faith management are able to effectively allocate their capital. Very, very strong every single year, but look at that, 61% in 2024, 87% on a trailing 12-month basis. This indicates to us very good in terms of management and the way they can allocate that capital. Investors and potential investors will love to see that. Now, regular viewers know on the operating margin, not only do we want to see above the minimums, but we want to see operating efficiency. We want this to increase over the longer term, and definitely something we have noted. Granted, we were looking at the gross margin earlier. Even the operating margin is showing efficiency signs, and as we will show you later on, these are much, much higher than the sector median. 62, very good on a trailing 12 month. Same to say for the free cash flow, looking incredibly strong, 49 on a trailing 12-month basis. Definitely right now, Nvidia is a free cash flow machine. Final metric, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see for the industry, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. Not even one day, not even one day. Look at that, 0 across the board, 0 on the trailing 12 months, 0 over the next 12 months. And remember, this correlates to balance sheet strength. So Nvidia, as we will also show you shortly from the balance sheet review, has a very strong balance sheet. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we look at severely undervalued stocks as well as what's gone in the market over the last few days. So click on the pinned comment below, sign up, and you can start reading straight away. You'll also be able to gain 40 undervalued stocks for the month of November, where we take a look at the upside that each one has over the next year based on Wall Street's projections. And on top of that, a spreadsheet of 22 undervalued dividend stocks that Wall Street believe right now have the most upside in the S&P 500. So click below, sign up, and you can start reading straight away. We then take a look at insider ownership, sitting at 4.23%, around 1 billion worth of sales by insiders over the last year. And we also notice in Q4, the more recent period, 36 million worth of sales. Q3, the most over the last few years, at 532 million. Now, we'll show you who these insiders are. In fact, the most recent one was the director on the 9th of October. But as we do say, insider selling isn't necessarily a bearish signal. They sell for many reasons, personal or financial. Information, though, is here if you want to take a look and use it as part of your own investment thesis. Now, the same to be applied for institutions, 66% ownership, 30 billion sold over the last 12 months. Same time frame, a mammoth amount more, 290 billion during the same time period. And we do notice in the more recent quarter, more buying than selling, but very interestingly, we actually see quite a lot being sold 24 billion, not something we have seen over the last few years, noted by the graph, in fact the red depicting sales, so just something to bear in mind that, as we always say, whether insiders, whether institutions buy or sell, always do your own due diligence. Now, other things that we do want to talk about, we've already flagged here essentially their top line revenue. We can see the growth over the last 10 years, and we've already depicted that massive amounts of that has just come over the last year and expected into January 2025. But what we want to highlight here is what is the story the bottom line net income tells us, and we can in fact see here over the long term it does follow a very similar trend. In fact, just over the last year we see a large jump. In fact, from the last 10 years it's gone from 631 million to just under 30 billion, and based on the trailing 12 month of 53 billion, we expect January 2025 to be an absolute mammoth year for Nvidia, continuing with that ball rolling in the right direction and upwards. Then we want to highlight the balance sheet here in terms of the total health, cash versus total debt. And what we notice here, essentially, their cash has been increasing over the long term, pretty much in line with their revenue, going from 4.6 billion in 2015 to 35 billion in the latest quarter. But as always, in isolation, one number will not tell us anything, which is why we compare it numerically and directionally to their total debt, which, yes, has been increasing, not something we typically want to see, but going from 1.4 billion to 10 billion in the latest quarter. As we just saw, cash is well above that, far superior, and as highlighted from the net debt to EBITDA at 0, it won't take Nvidia one day to pay off all of their debt net of cash on hand. Then we want to get into some gradings where they get an F. Now, P on a non-GAAP basis of 51, as we just mentioned, significantly higher than the sector median, 24.4. Essentially, you're buying this company right now, you're paying a 111% premium, and this is reflected pretty much in every single other valuation metric used. Nvidia trades at a very high premium to the overall sector. Now, is it worth the premium? Probably answer is yes. Again, how much of a premium? We're going to allocate a margin of safety later as well, but these are things you need to consider. Now look, they deserve a premium purely on the fact, as we'll show you, growth A+, year-on-year revenue growth nearly 200%, sector at 4, moving forwards 90%, sector median at 5.6, and essentially the earnings per share over the next 3 to 5 years is expected to grow at 35%, a lot better than the sector median at 15.3. Again, we see profitability a lot better than the sector, A+, gross margin 76%, sector median 50.3. Bottom line, that is absolutely phenomenal. I challenge you to tell me any company that has a net margin anywhere near that. That is really strong. Do not take that for granted. Sector median 3.55. And one thing that really stands out, their cash from operations over the last 12 months, 49 billion, sector median 94 million. So a quick recap for this part of the analysis, just Wall Street with a strong buy, although we're going to go ahead and say Quant have given it a buy. I mean, it's 0.01 away from turning this into a buy, and Seeking Alpha giving this a hold. Now valuation, F, no surprises, we ran through Y, growth A+, profitability A+ as well. Now two things before we do essentially jump into the valuation model. Let's compare their performance against others in the semiconductor space. TSM, Broadcom, very large names, very well known, also performed very strongly. Nvidia, though, the winner, up 189% over the last 12 months. I mean, this is total return as well, so it includes that very small dividend reinvested. Over the last 5 years, up insane 2,670%. Over the last 10 years, up nearly 29,000%. Now, absolutely phenomenal, but do remember, it's very important, past performance does not dictate the future. They could perform a lot better, they could perform significantly better, but they could also perform a lot worse. Definitely something to consider. And you probably already know the answer, but just to highlight the outperformance of Nvidia against the S&P over the last year, over the last 5 years, as we can clearly see, and over the last 10 years. Typically, we show this because we also want investors to understand that you can, if you don't have that conviction in individual stocks, consider a low-cost ETF that maybe tracks the S&P like Vogue. Now we're going to jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value at $140, we got this by running it through the DCF model, and essentially we have the free cash flow year on year, we have the 5-year growth rate at 135%, the 10-year growth rate at 94%, and then we're essentially using a growth rate of 30% moving forwards, which is our medium rate, 25, 30, 35. With the discount rate, we get the present value of future free cash flows and terminal value, add together the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we're getting today pretty much $140, which is the same as the price right now after hours, indicating no upside. It is at fair value. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others that you do desire. For full transparency, we will show you though at the 25% rate, essentially intrinsic value $101, indicating downside of 28%. For those that are more bullish at 35%, intrinsically $193, 38% upside. And as we saw, Bloomberg 42% projected rate over the next 10 years. This gives us just under $300, which is more than a double from the current price, indicating 112% upside from today's value. Now we want to take through the medium rate of 30% today, and what we always like to do is run a margin of safety. Typically we execute on companies at a 10% MOS if they meet our golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode, a buy up to $126. But what this highlights, right now, we believe Nvidia is trading at its fair value. And you know what? Some investors will look at this company and say, we'd buy this at a premium, so we'll definitely buy this at the fair value. But for those that want to see, even at a 5% MOS, you need to wait for 133. At 10%, 126. At 15, 119. And at 20%, $112. Now, right now, as we said, we believe this is trading at its fair value. Wall Street, on the other hand, they believe upside of 18%. Their price target over the next year is $165. As always, though, give us your thoughts in the comments below. Is this one that you're happy with in terms of the earnings? Were you expecting more, a bigger beat, further guidance in terms of lifting their revenue, their EPS? And whether you're buying, holding, or selling. Like we said, if you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of videos as they drop. Don't forget to sign up to the free weekly newsletter below and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.